Good morning. Good to see a lot of faces we haven't seen in a long time here. Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, Investment Recipes for Challenging Time, is really a session on skill. As the markets get more and more competitive, we're all asking ourselves, is skill an asset class? What are the qualities, what do these qualities look like in a manager? Today we've asked three legendary investors here to tell us what they do. Hopefully we can read between the lines. I'll introduce them briefly after I say this. The speakers' views are their own and don't necessarily represent the views of the roundtable. So with that, I'd like to introduce our speakers today very quickly. David Abrams is the founder of Abrams Capital, a value-driven hedge fund that invests in a wide spectrum of instruments and situations out of Boston. Before starting Abrams, David was a protege of Seth Klarman, the author of Margin of Safety and the head of the Baupost Group. Sitting next to David is Chris Hohn. Chris is an old friend of the Roundtable and a founder of the Children's Fund, a fundamental activist hedge fund based in London that runs $5 billion in concentrated positions. Before TCI, Chris managed the European Event Fund for Perry Capital, opening their London office in 1998. Before Perry, Chris worked for the private equity firm Apax Partners. Chris also co-founded the Children's Investment Fund Foundation, one of the largest charitable foundations in the UK, helping children in some of the poorest countries in the world. Sitting next to Chris is Richard Dietz. Richard is the founder of VR Capital Group, a $2 billion hedge fund specializing in distressed debt and event-driven strategies. In the emerging markets. Before starting VR, Mr. Dietz was a founding partner and head of fixed income trading at Moscow-based investment bank Renaissance Capital Group. Before that, Richard was a managing director at Credit Suisse, where he opened the firm's Russian and Eastern European derivative businesses. And the moderator of the Greenwich Roundtable today is Rian Dartnell. Ryan's the Chief Investment Officer at Granite Associates, the investment office for the Geary family, and a trustee of the Roundtable. As you know, Ryan, in the last 10 years, has organized some of the most profound sessions that I can remember. Ryan was early to host sessions on China, India, Brazil, and Africa, and today, skill. Ryan?
Thank you very much, Steve. 10 years, a long time. We're getting old. So I would point out that Steve started this in 1996, 18 years in, going strong. Thank you all for coming. Nice to see you. Thank you to our speakers. Richard Dietz has come perhaps the farthest. I didn't do the distance, but he's in from Moscow. Chris is in from London, and David is in from Boston. So thank you for your efforts to be here. I know you live busy lives, and we appreciate the fact that you're here to educate us. I started to think that this panel would and should be about Europe, hoping that the crisis would have turned up some opportunities, and we'd hear about those. As we started to develop the panel, I thought it was a better idea to give our speakers a broader canvas to speak about. Now, all three of them are very involved in Europe today, so I'm sure we'll get into that. Ours, as Steve was saying, skill. Our speakers are steeped in the ethos, the psychology, the science, and the art of investing. Each has their own investment recipe, if you will. I did think that they had a number of things in common, so I'm just going to run through a few of those and then hand over. The first is that they all founded their own companies in their 30s, and into their second decade managing their funds, they've thrived and survived, and I think that's saying a lot in itself. The second is that they've all been very successful at taking the emotions out of investing. The third is that all three, I would say, are quite concentrated investors. They build up high convictions through their own fundamental research, and then definitely they're not afraid to be, shall I say, assertive at times, and no doubt they will embrace complexity if they think it's worthwhile, or in fact if they need to. Fifth, these investment chefs definitely eat a lot of their own cooking. They have the majority of their net worths invested alongside their investors, and I think that's important. And then I think the last and probably the highest praise I can put is that all three buy low and they sell high. They assure me of that. So rather than go on, I thought it would be fun to do something slightly different. So for the last couple of weeks, I've been reading back through my books, through Poor Charlie's Almanac, through Securities Analysis, and looking for quotes on each of these speakers, trying to think what is most descriptive of David Abrams. So David, you get a Charlie Munger quote. And Charlie says, "It takes character to sit there with all that cash and do nothing. I didn't get where I am going after mediocre opportunities." So with that, David.
Thanks, Ryan, Steve, for the introduction. Thanks to everybody for being here. It's obviously an esteemed group, sophisticated, so I'm honored, and it's also a great honor to be on the panel with Richard, who I've heard about, and Chris, who I've known for a long time. We were reminiscing. I think the last time Chris and I saw each other was in 1996 or 1997. We were both poking around Seoul, South Korea, trying to find cheap stocks in the wake of that crisis. So some of you know me, but not all of you do. So I thought I'd just take 2 seconds to talk about our approach, and then segue into a little stuff about some of the things that Ryan would ask us to address. So we get lumped in with hedge funds, but we really is a long-only opportunistic fund. We do debt, we do equity, we do public, we do private, we do distressed, we do non-distressed. We do like to be concentrated, as we like to say. We believe in diversification, but we don't want to diversify into ignorance. So we try to keep the number of positions to 15 or 20, thereabouts. It gets a little bit more as we've gotten bigger. We also, and I think it's interesting too, because I was just talking with Richard a little bit before, and Chris and I were talking, that actually all three of us, even though we all manage, I think, a decent amount of money, have relatively small teams, and it's on the research side for me. It's myself and 4 other people. We also don't feel like we have a mandate to be fully invested, so we'll have lots of cash at times. So I think that speaks a little bit to what Ryan was talking about. But beyond that, we're pretty flexible. We'd rather buy better businesses, but we'll also buy crummy businesses. We'll buy assets and whatnot. We've traditionally been mostly in the U.S., but one of the things that we like to do is to look for stuff under a cloud. And obviously, not necessarily the last 6 months or so, but over the last 2.5 or 3 years, Europe has been under a cloud, and so we've turned our attention there. And we've made, probably a dozen or more investments over there, and knock on wood, they've turned out to be good. I do personally like to look at situations that I think are unstable because they'll have to resolve one way or the other at some point down the road. And I currently view Europe as unstable, even though the prices are up and probably the fishing's not so great, at this precise moment. And by that I mean, I think what everybody who's spent time thinking about acknowledges that you have, one currency, a central currency, but all these political states with different budgets and whatnot, and that's just, I think a recipe for future instability. Even though in the short term, the authorities have been able to effectively jawbone the market up without actually spending any money on the OMT. And we'll see what happens. Somebody was speculating to me yesterday that actually if they had to spend money on the OMT, the Germans might not actually let them do that, but we'll see. So I would say, as I look forward, kind of an interesting thing to keep a close eye on, because when you have an unstable situation with these ultra low rates, haven't really fixed very many of the problems. There are some exceptions. British banking is somewhat on the mend. The Spaniards have starting to do some stuff with their banking system, but the Italians, are nowhere. And I think also the Germans also need to recapitalize their banks. So, I would say probably more opportunities in the future as you go forward. It's interesting you mentioned Charlie Munger, because one of the things I always recommend young students to read is his speech on mental models, which I think is one of the really classic things. And for us, as we invest in a wide array of asset classes, it's important for us to have different mental models, because the way you think about some distressed asset, I think, is really different than the way you think about a good growing company that might have high barriers to entry. And the way you think, as we do stuff on the private side, and in the last couple of years, we've actually funded and started back some people and kind of helped start companies. And when we get involved with companies, we do get involved with them. For the most part, we don't exactly do what Chris does, and he's doing God's work to go and try to get people on the straight and narrow. I don't really do that as much. What I try to do is get involved with companies where we like the people and we want to help them grow, as opposed to we need to re-educate them, which Chris does very well, and I just follow on his coattails occasionally. So, but when you're trying to work with a group of people, I think a lot of people know this from their own experiences in business or whatnot. You need to have a different mental model, a different approach for that than when you go in, you're trying to analyze the Enron debt, which a few years ago was a big position for us. One of the things we were talking about in preparation for the panel was some of the things that distinguish you. And one of the things that I pointed out was this kind of psychology that one of we as investors, I think, have to always try to balance keeping your inbox full, having a lot of input, but then also at some point you really have to tune out the noise, because there's so much information out there, and a lot of it just doesn't matter. And I think when we try to, all of our investments really can be boiled down into 2 or 3 sentences. Like, this is the idea, these are the things that matter. And what we find is if you can't do that, it's probably not a good idea. It's sort of in the Charlie Munger too tough bucket. And so we'll if we can't boil it down very simply, we'll put it there. And although we do look at complexity, the reason to look at complex situations is not per se because we like complexity. It's actually because they're a barrier to entry to other investors. And so really the point of looking at complexity is that if you look hard enough and you study enough, sometimes, not all the time, sometimes in the core you'll find a very complex core, but sometimes you'll find a very simple core. And again, to use Enron, in the end, on day one it was very complex, but as we slowly peeled back the onion, it was a very, very, very simple core there. And so that's the other point to make. And I guess the final point I'll make, I'm not keeping count of the time here, I'll pause and turn over to the next speaker, but is, in the end, investing, regardless of the type of asset, whether it's distressed or non-distressed, it's good or bad or ugly, the key is there's a math behind it. And one of the things we do, I don't always say this in public, but I will today, is that one of the services that we provide to our clients is that we separate our clients from their own emotions, because we're just not that emotional about it, and we look for the math in the end. So why don't I stop there and turn back to Ryan.
Thank you, David. So, Chris, you get a Warren Buffett quote from his 2008 annual letter. So Warren says, "Long ago, Ben Graham taught me price is what you pay, value is what you get, whether we're talking about stocks or socks. I like buying quality merchandise when it's marked down." Chris?
Thank you, Ryan. That's a good summary of what what our fund does. The bedrock of our investing philosophy is a strong business. Strong meaning that It has high barriers to entry that are sustainable over a long period, not 1 year, but 10, 20 years. As Buffett said, without having that moat, you have no idea what an asset is worth. Absolutely no idea. And so, people label us this and that, and actually, in fact, many investors don't invest with us because they don't know what bucket to put us in, and so we say, just put us in the bucket of an intelligent investor. We can do debt. We're global in equities. We're pretty much long only, occasional shorting, but a very it's not exclusive, but the dominant theme is we buy an excellent business, and we're very global. Although today I would say Europe and the US are going to be the vast amount of our capital. Now, the question that the Buffett quote leads to is, well, how do you buy an excellent business at a bargain price? And of course, there are times where everything is marked down, like 2008, and then you can buy anything at a cheap price. And we bought a lot of Coke and Nestle, 10 and 11 times earnings. People said, "Oh, you're an activist fund. What are you doing there?" And plenty of people sacked us for owning Nestle. We said, well, Nestle is one of the best businesses in the world. It's compounded at 14% a year for 20 years. There's no risk in it. And but people said, you don't have an edge. Where's your edge? We owned Disney. We put 10% of our fund in Disney, 2 or 3 years ago at 10 times earnings. And people said, the same thing. But what's in a crisis? Yeah, that's clear. Now today, in a period of non-crisis, which is more the norm, how do you find an excellent business at a bargain price? Well, the way that we have found that can be done is finding out-of-favor situations. As David said, companies under a cloud for many reasons, and that could be the ownership is a questionable shareholder is controlling the company, or is a large shareholder. It could be litigation. It could be a misunderstanding of the business model, or an industry that's controversial. And it's not that those issues that are causing the cloud are irrelevant. Oftentimes they are real, but the point is that typically investors over-discount them, or frequently they over-discount them, and they take an attitude is that they'll just stay away at any price, and that can create huge opportunity for an investor who can basically do things which are non-mainstream and scare off other people. I'll talk about briefly some examples of that. But you'd also have to exploit that. You need a time horizon for the investors to realize that the cloud is over discounted, or for the cloud to go away, or alternatively to change the situation through constructivism or activism, which is also something we'll do. It's in our toolkit. We don't really consider ourselves activist investors, but we are. It's certainly a tool we're happy to use, but we are always engaged in a very active way with companies. So our competitive advantages we see as a deep understanding of certain business models in a limited universe of industries. The majority of industries we don't touch or waste time in. and expertise in governance, and thirdly having a longer-term investment horizon. So, I'll give you 3 quick examples to illustrate. A year and a half ago, we put what peaked at 18% of the fund into News Corporation shares. The shares were at $15, just over a $30 billion market cap, and the shares had fallen on fears of a phone hacking scandal in the UK, and they were always already very cheap because of a Murdoch governance discount. The concerns that Rupert Murdoch was, as a controlling shareholder, was out of control, buying overvalued businesses and just burning the shareholder value. And what we looked at was actually that this uncertainty and fears over governance and litigation created an immensely cheap stock. The stock, when you took out the value of their stake in Sky, was trading at 4 times EBIT. Now, those of you what was the business? It was predominantly cable TV channels like Fox News and regional sports networks, a big international business in emerging markets, and it had been growing revenue at 20% a year, and through pricing, and actually pricing had been growing at 20% a year for a decade, and profits at 30% a year without capital. So it was an incredible business, and trading at a bankruptcy valuation. And in addition, the company actually rang the bell by announcing a $5 billion buyback that we were convinced would end up being $20 billion, and that they were going to, if necessary, take the company private and respond to the very cheap valuation. It was classic Soros reflexivity, that the stock market can affect the real world, and vice versa. In this case, the extremely cheap stock had triggered a desire there to, instead of going and buying Sky, use the $12 billion cash pile and the $5 billion a year of cash they were generating to just massively buy back stock. And the arrival of Chase Carey, his COO, who all he did at DirecTV was buy back shares, reinforced that. So, yes, was the hacking scandal real? Yes, there was going to be probably a $20 million pre-tax fines and settlements. But a $50 billion discount to the stock was being priced in by the stock market. So
Do you say 20 million on the penalty?
20 million fines and settlements for for the different people, celebrities they had hacked phones of, but a $50 billion discount was priced in. But you talk to investors and say, why are you selling the shares? I talked to a good friend of mine. He sold the shares when I was buying them, and he said, I can't invest in companies where there's an FBI investigation. How can I explain that? And so it's what Buffett said. You need 2 things for this business. One is analytics, and it's not information. David and I were speaking, and one of the things David said is most investors have the same information. Okay, and actually, I would say add to that, a large proportion of investors also have the analytics. But his third thing Buffett said is the second thing is the temperament, and here people became emotional over, and so this was a fantastic opportunity. In a year and a half, the stock has doubled, and they broke the company up, and what was our insight was to see that there was an inflection point in governance, not just that it was mispriced and an excellent business, but they were going to change and clean it up. A second example of something that we invested in a couple of years ago, again, we run concentrated, we made it 15% of our fund, is Japan tobacco. And tobacco is a sector that is highly out of favor with investors relative to fundamentals. It's grows through pricing power, and And this is a company is a huge international business and was generating about $5 billion a year of cash. And the stock had collapsed because the fears over corporate governance, out of favor equity markets in Japan, and the stock was trading at 7 times earnings. We knew the sector, the first, back to our days in Korea, the first stock we bought in their fund when we started in 2004 was Korea Tobacco and Ginseng. And David's laughing because when we were in Korea looking at stocks, they used to worry about being served roast dog at night. Which,
better worry about being served horse in London.
We can swap culinary stories here.
Anyway, the stock was worth 3x, but the company was completely mismanaged. And it was, some would say, yeah, it's cheap for a reason. Yeah, they didn't give you back money. And it was because of the Japanese government's ownership, of controlling shareholder 50%. And when the tsunami hit, we did something quite mad. We lobbied publicly for the Japanese, in the Japanese media, quite aggressively for the government to privatize the stock, as we knew there was a massive amount of money to be made if they could privatize it and clean it up. And we persuaded them to do so, and then we explained that the stock was so cheap because they would sell it very cheaply unless they cleaned it up. And so we put hostile dividend and buyback proposals on the AGM and pushed hard for them to. And in fact, the one positive thing is that management aligned with us because they also didn't want the government in there as a boss. Company announced a buyback, a large buyback of shares, massive hike in dividends, fired the CEO, brought in a tobacco executive instead of a government bureaucrat, massive profit guidance and targets. And there were a number of jewels in the company that people just didn't look at or understand because they just said this is a bad situation. They have 40% share of the Russian cigarette market, and those prices are going from 50 cents to $5 over time, and the profits are going to grow from around $1 billion to as much as $5 billion. And they have huge cash machines. Last year, they just price alone internationally, they added $1 billion to their profits with volume up. So stock has doubled, and but it definitely was. Had everything that illustrating the things that we do. And final quick example, if we have time, is Porsche. Now, so 3 examples from around the world, one in the US, one in Japan, one in Europe. So we have probably a majority of our assets in Europe because we do think Europe scares the hell out of people, and that's created opportunity. We have expertise there. I've been investing in Europe for 20 years. So in the summer of 2012, Porsche shares were trading where they'd been trading for the last 3 or 4 years at 40 euros per share. And Porsche was a very complicated situation. They'd taken control of Volkswagen, a giant auto company, in a hostile takeover. Actually, they took control at a P of 3, and the situation, the company, they over-levered themselves at the time, nearly went bankrupt, and it was chaotic. They had to sell their Porsche car company to Volkswagen as part of a deal, and nearly lost control of the company. They had to bring Qataris in, and in this chaos, pretty much all the large hedge funds of the US shorted Volkswagen shares and were caught in a massive short squeeze, losing billions, and decided to sue the company for fraud, sue Porsche. So this mess made the shares uninvestable for investors. They said this is litigation, this could bankrupt the company again, and just completely uninvestable. You go to the investor day, just like for Japan Tobacco, there's been nobody there. And David's old shop, Baupost, which I always smile about because the first job I tried to get when I moved to the US to try and get married was to go to Seth and ask him for a job, and I offered to work for nothing for him for a year, and he turned me down.
With all his success, everybody makes mistakes.
And but fortunately he did refer me to Richard Berry, so he was kind enough to do that. So I'm always grateful to Seth. Anyway, the situation was very out of favor. That's why I just mentioned Seth. The philosophy of Baupost is buy out of favor things. That's where you can get a bargain. And this, so we started to study this. What attracted us to it? It wasn't that we liked the car industry. We hate the car industry, but there is some. But Volkswagen wasn't a commodity car company. The majority of the earnings are coming from luxury brands, which, because of their brands, actually give sustainable high margins. So Audi makes 6 or 7 billion euros of EBIT and is growing like a train, and Porsche is on its way to making 3 billion euros of EBIT and makes 18% operating profit margins. And there's a big truck business. Actually, the Volkswagen brand itself is around only 20% of the earnings, and it's not a European car company, it's a global business, and so it was misunderstood. So because of the crisis in Europe and perception that Volkswagen was just a commodity European car company, people were pricing Volkswagen around 4 times earnings, and they were applying a 45% discount to that market value on Porsche because of the litigation and complexity. And so you had a discount on a discount. When you looked through, you were buying through Porsche, Volkswagen on a P of 2. Volkswagen was making 12 or 13 billion euros of net income at 15 billion euros of cash, and was growing with high levels of profitability everywhere. Market shares had become 25% today in Europe, 25% in China, 25% in Brazil. It was a winning company. And what did we see? We saw 4 ways to win. Volkswagen goes up a lot. They pass through all the dividends from Volkswagen as they announced. You could get a 15% dividend yield. Thirdly, the litigation was bogus and would go away. And fourthly, that Porsche and Volkswagen could merge, eliminating the discount. And so we made this a largest position. And one of my investors, one of my analysts came to me, was upset with me. He said, "Chris, you're gonna, this is gonna be dead money for some years. Investors will fire us." And I said, "Edgar, you could well be right. Actually, I think that could be the case. But I think this thing will triple over three years. And for my own money, a very large part of the fund is I want to be there. And so let us be fired." And so part of the point about to do this, you have to have a time horizon, and you have to be prepared to be fired because it could stay out of favor for a while. And investors are often impatient, and you have to be prepared to be fired. When we bought Japan Tobacco, one of our largest investors, who had $80 million with us, said if you buy that shares and bring us into the controversy of being activist in Japan and tobacco, we'll fire you. And they did. They fired us. And so I'll stop there.
Richard, your quote is from Warren Buffett as well. "The best thing that happens is when a great company, or country in Richard's case oftentimes, gets into temporary trouble. We want to buy them when they are on the operating table." Richard.
Well, Warren Buffett says everything better than I can, and I would have to agree with him there.
All I do is quote the good guys.
Yeah. So let me make a few remarks. I think two panelists before me really did such a good job of describing their businesses and their investment philosophies, which are not really in many ways so different than ours. So it leaves me maybe with a little bit less to say, but nevertheless, I think I can muster a few words for you here. At VR Capital, we principally invest in distressed securities. Largely, we do that in emerging markets on a very global basis. We also invest in distressed securities in developed markets, and we do other strategies which tend to fit broadly under the rubric of event-driven or value-oriented strategies. We have tend to have a fairly contrarian approach to investing. We question constantly common wisdom, consensus. In particular, I'd say we get very interested in situations where there's an extraordinary consensus to the point where we find that people who are relatively uninformed hold views very strongly about something. That's generally a sign for us that there may be more to the story than people tend to think. We do, to Ryan's comment, we like when countries go through crises on an investment level, let's say on a social or personal level. But we have found through our history really extraordinary opportunities in economic crises. I founded the business in 1999 in the wake of the Russian crisis. And whilst when we founded the business, the idea from the beginning was to do a globally oriented fund, our early years were really focused almost entirely on Russia and the former Soviet Union. Why? Because let me give a digression. In 1994, I moved from New York to Russia. I used to work at an investment bank in New York. I moved to Russia. I had been managing director in New York. I convinced the firm to create a job for me in Russia. I rather ungratefully repaid them for that by quitting 4 months after I got to Russia, and taking let's say together, 4 of us who were the senior people in the office in Moscow left the firm together and founded an investment bank in Russia. And that's what I did from 1995 until, let's say, shortly after the Russian crisis. So when we founded the firm in 1999, Russia had just been through a crisis. It was actually the area we knew very well. It's a very, very important thing for us to feel like we know and have some kind of edge in the investments that we're doing. And so we used that opportunity, the Russian crisis, in our initial years to really get ourselves going and get off to a very fast start. But then if we look through our history, there's been a reasonable succession of these crises. 2000, let me leave even before that. 1997, you also had an Asian crisis before the Russian crisis. And so once we finished kind of cleaning things up in Asia, or in Russia, we went to Asia because even though that crisis had predated the Russian crisis, there was just a lot more. There was a lot more material to burn, and the conflagration was much bigger, and it consequently took quite a bit longer to clean that up. And so we had some success cleaning up distressed securities in Asia. And then, fortunately for us, right after that, right after we kind of got done cleaning things up in Asia, Argentina went through a gigantic crisis. And we essentially moved all of our assets, not all of our assets, but we went from having never invested in Argentina to focusing all of our efforts on the country, learning it, and a year and a half later we had 2/3 of our assets in Argentina in a whole variety of situations, but we had very, very strong conviction about the opportunities there. And then maybe, in terms of just the last, continue with the crisis theme, 2008 was not a great year for us. 2009, 2010 were outstanding years for us. And when the Lehman crisis hit, I think because I don't know if we have recipes for investment success. We probably have some playbooks or a toolkit of things that we know how to do. And notwithstanding kind of the difficulties, including difficulties in our own, within our own balance sheet or fund, let's say in NAV terms, not so much in balance sheet terms, with the Lehman crisis, we understood from kind of the day Lehman filed for bankruptcy that we were an outstanding investment environment, and that what we really needed to do was focus on exploiting that crisis. And then the Eurozone crisis in the last few years has been another set of opportunities for us. So I think there is if there's a common thread through our history of investing, one common thread, and probably the strongest one, has certainly been looking to crises for opportunities. Where do things work? I think things work for us when we can develop an investment thesis that's a non-consensus thesis, and over time it may not become consensus, but it becomes less non-consensus at least. I mean, that usually is enough if you're investing in the right way and you have enough of a margin of safety. Things simply going from completely hated to some level of indifference that people would have towards an asset.
Completely hated to merely despised or something.
Yeah, exactly. Usually works pretty well, and sometimes actually you're more right than that, and they go from completely hated to some form of consensus, or you have an event-driven situation where you don't really even need people to change their opinions about an asset because some kind of event is going to happen which is going to take you out in a cash or some kind of transformation that's going to catalyze the value. I'll talk maybe in a few minutes about, with some specificity, about a couple things that we've done in the Eurozone, since I think at least once upon a time the theme for this breakfast was Europe. But before that, maybe three things I'd highlight that I think are really important. Not so much, they're not even recipes for investment, they're not even a toolkit so much as kind of requirements to be able to invest, to be able to be successful with the kind of philosophy we have. First thing I'd say is balance sheet flexibility. We really, really, really want to be able to buy things when we want to buy them and sell things when we want to sell them. And that means that when there's opportunities to buy things, we need to be able to have the cash or have the balance sheet flexibility. And we need to make sure that we have the ability to hold our assets for the time period that's necessary. And that holding the assets for the time period that's necessary is pretty important because the next thing I wanted to highlight was maintaining the courage of your convictions. And many of our best investments, maybe even most, certainly in recent years, I would say most of our best investments are at some point, in some interim point in our holding period, don't look like very good investments at all. And it just seems inevitable. I don't know whether it means that we have, we don't have. Sometimes we have exquisitely bad timing or exquisitely mediocre timing, and that may be a statement about our limitations. But I think the reality is that if you're a value investor, you know a lot more. It's a lot easier to say where an asset can be in 2 years or 3 years, and you have to be willing, and I think Chris and David more or less said the same thing. You got to be willing to accept the fact that, when somebody asks you what's my mark to market going to be in 3 months, the real answer is like, who the hell knows? It's going to be somewhere. It could be up, it could be down, but that's not really the important thing. And I think it's actually talking about other barriers to entry. I think it's some of the investments that we do that are successful. It's also a barrier to entry. There are a lot of investors who really worry a lot about what is this going to look like, how much volatility is it going to add to my portfolio, what's the market going to be, in a month or two. And to the extent that that keeps some investors out of investment, well, from our perspective, that's a good thing. The third thing I'd highlight that is something that I think we kind of constantly do, and seems to kind of, it just seems to kind of work for us, is we spend a lot of time in our investments trying to put ourselves in other people's shoes. If it's a restructuring, if it's a corporate restructuring situation, we think it's natural to look at an investment and analyze it from your perspective. What does it look like? How do you think about it? But to the extent you're going to be negotiating with someone, and especially when you do restructurings in emerging markets, you're typically really negotiating with an equity holder. You're not sitting in a court with a judge and kind of playing umpire and calling balls and strikes. It's really important to think about how this entire negotiation looks like from his perspective or her perspective, and what it is that's kind of driving their decisions, and what are really their indifference points going to be, and how far it really helps you understand how far can you push a particular situation. And if I were to, and it's not just, that's kind of in a corporate situation, we do a lot of sovereign work. And in sovereign work, the questions become even more complicated. In a corporate situation, you're generally talking about things that are largely issues of business and money and bottom line. In sovereign situations, it becomes a lot more complex. You've got issues of politics. If you take the Eurozone as probably, as a good example, and I'd say the most, from my perspective, the most complex and interesting set of sovereign restructuring questions, largely because it's much more than dollars and cents there. It's you have the EU and the entire political project, which is, starting from the 1950s and going through all the steps of integration that ultimately led to the euro, and what that would mean if you started to unravel that, and you have multiple parties. You've got nation states. You've got politicians who have to get elected and answer to their electorate. You've got kind of more EU-wide, the Brussels kind of constituency. You've got the ECB. You've got the IMF. You've got the banks in many countries, and the questions about how these different paths to resolution can impact the national banking systems. And so we really, as we've spent a lot of time in the last couple of years in the Eurozone, really try to put ourselves, a lot of our discussions internally are about, what would you do? Like, what would you do if you were Merkel? How would you advise her if you were Schäuble? Or how are you thinking about the elections that you've got coming up versus the how would you position yourself if you're the opposition there? And then, I'm just picking Germany as an example, but kind of across the Eurozone, those are a lot of the things that we've thought about. And generally we find that doing that, or very often we find that doing that and just kind of gaming out how a situation would play out is actually more valuable than spending a lot of time trying to learn that kind of elusive piece of information. What did Merkel say to Hollande at the meeting, at their dinner, and who has that piece of information? Probably nobody has it, or somebody has that information in the markets. We're usually the last people to find it out. And we're certainly not going to be the first. So even if we do find that out, how valuable is the information at the point that we found that out? And generally, if you think about it, they probably say the things, if you understand their imperatives right, then probably what they said, you can figure out what they said without having to get somebody to kind of tell you.
People are on the edge of their seats, they want to get into the action. You want to talk about some of the investments you have today and what the outlooks are?
Yeah, sure.
Okay.
Sure. Let me talk about, I'll just talk about two things with respect to Europe. One, it's all going to be a little bit historical, so it probably will make you back away from the edge of your seats a little bit. But the first thing is, how did we even, for guys who do emerging markets primarily, I mean, we do some developed markets distress, but how did we ever get involved in Europe? Well, I mean, the way we started was in 2009, 6 months or say in the spring of 2009, after the Lehman crisis, when markets were beginning to settle down a little bit, but we're still significantly dislocated. We just sat down and started thinking about the fact that this enormous fiscal response in Europe, and yet kind of government bonds were seen as part of the answer to the flight to safety at that time. And we started looking at spreads in Europe, in Western Europe, and we started comparing them to emerging markets. And the more we did it, the more we just kind of scratched our heads, because you'd look at Russia or something. Let's say Russia at that time had CDS that was trading at 500 basis points, and Russia has like an external debt of single-digit percent of GDP. It wasn't kind of on a first-order basis impacted by the crisis. It suffered a lot of second-order impacts. Didn't have a rotten bank system. There had to be a little bit of, there was some quantum of central bank support, but you didn't have kind of the deep embedded problems in Russia. And then you'd look at, take Spain as an example in terms of being in the periphery but not being the worst of the worst. And Spain CDS was trading at 100 basis points, so 100 versus 500. And Spain has a rotten banking system. They've got a real estate bubble. They've got a high government debt, certainly compared to Russia, moderate actually at that time in terms of the Eurozone, a structural and cyclical balance on the fiscal side that's very wide. So here you have Spain that's kind of looks pretty bad and clearly going from bad to worse, trading at levels that are so far inside. And the only way you could really square that is by saying that somehow the level of political support is so strong that Spain is really Germany. You're not looking at Spain, you're looking at Germany, and clearly, there was an element of that. It was hard to say exactly how strong that was, but we didn't underestimate that by any means. But we kind of just looked at that equation and said, listen, it's crazy. Like, one of the things that we do on kind of a macro basis just to hedge our portfolios is to short, sovereign CDS, that sort of thing in emerging markets. It kind of helps in our portfolio. And we decided just fundamentally to shift all of that credit, kind of macro credit shorting, from emerging markets to peripheral Europe at that time. And so that's kind of how we got involved in Europe. And before that, I'd never spent a minute in my life, I would say, looking at a government bond in Europe. It seemed like the most boring thing, way that you could spend time. And so that kind of helped. One, it got us started in Europe, got us very focused on it, and it actually really, really helped, because when Europe started to get worse and spreads blew out, we had a lot of kind of a big portfolio of embedded, very cheap kind of disaster insurance that we bought, and it allowed us kind of naturally to shift our focus to the long side and feel comfortable even when things look very shaky, saying, look, we can start to look at things that look severely dislocated in Europe, and if things really all blow up, we have something in the portfolio that should at least keep the explosion, to a level that we can deal with.